The Hedgeless Horseman here. It's May 7th, 2022. This video will be about why you must learn to love volatility and use volatility instead of getting abused by volatility. I mean, the more volatile a sector is in terms of price volatility, it gets harder and harder for everyone pretty much. But at the same time, price volatility changes the future expected returns in such a way that the most volatile sector typically can be the most profitable sector because price can overshoot and undershoot the intrinsic trend line, the intrinsic value of a business. But most of the time, since we tend to get greedy when it's going up and fearful when it's going down, it means that the more volatility, the more we as humans tend to make mistakes. And that's why, in the last video, I showed that article that said that the best investors or the best performing portfolios belong to dead people. Simply because they cannot get thrown out when they're fearful, or will not buy in when when everyone's greedy. They do nothing. They don't have feelings. They're just riding with emotion. So on a long enough timeline, volatility doesn't bother them, obviously, and typically, like Buffett says, in the long term, the stock market is a weighing machine. In the short term, it's a voting machine, and it's the voting machine that creates the volatility. So it's like what I talked about, buying the future based on short-term prices. So if you want to have really good, the best returns you can get tend to be in the most volatile sectors. The hardest markets to beat tend to be volatile sectors. So pretty much either you get it and abuse it, or you get abused by it. That's why if I had to guess, I would say that, okay, 5%, 1 in 20 people beat an index over the long term. And that goes for, let's say, more typical stocks with less volatility. In the mining sector, I would just guess that it's even less than 1 in 20 because it's volatile. But that also means that because it's so volatile, you can make even more money in this sector than in the overall stock market. And again, it's like these are pretty simple concepts. This is the share price action everybody dreams about. Why? Because it's emotionally convenient or comfortable. Because every day you can pat yourself on the back and say, I was smart because the market, quote, agrees with you. My buy yesterday or my holding yesterday looks good because it's up more today. So I look smart. Every day the market is telling you, you're so smart, you're so good, you're so smart, you're so good, you know how to do this. Whereas this kind of share price action is what people hate. Long periods of doing nothing, and this is just one shape. It typically it doesn't go like this, typically it goes more like this. But declining prices is something most people cannot stand, because they, again, their conviction comes from looking right in recent past. So imagine if you're looking wrong or barely right for an extended period of time while you're watching these people shear every day, looking smarter and smarter and smarter. Obviously, if you did monthly purchases, they didn't try to time the market. You invested like a dead person, but you actually deposited money. So you deposited money monthly. Obviously, you would make a lot more in a stock or a market like this, because you were buying at way lower prices than the person who saw this kind of action. At the end, you would have outperformed this person by a lot, assuming you stuck to it. If you sold here because you saw all of this, you saw the gap here, and this guy was bragging about how much money he made, he's in a hot sector, you get envious and you see, okay, I've been buying for months and months and months and nothing is happening, I'm barely making any money. Mark is saying I'm stupid. This guy is saying to himself and to everybody who wants to listen, I'm so smart, I'm so smart, look at me. And let's say you sell out here. Okay, you jump here and sure you'll get some return. If you'd stuck to it, you would have beaten this person's return by a mile because you would be sitting at such a fat. You've been able to buy many more shares than this person because you were paying less, and then you would have an even greater cumulative return on your shares. So, like I recently had a talk with a friend. He's invested in he invests in stocks, not particular mining stocks. He's more into growth stories, but more traditional growth stories, let's say. And this is the chart of Evolution Gaming, which has been one of the most popular stocks in Sweden on the Swedish finance Twitter, let's say, over the last couple of years. I mean, it's perhaps understandable when you see this kind of, compounder, let's say. And typically, I mean, this was the rave all the way up here, this stock, pretty much. There were a lot of people that had like 50% of their entire portfolio in Evolution Gaming. And, declines typically were kind of shallow. I mean, 20-30% declines perhaps. I mean, it just lasted, a month or two. Then you were back to looking good and smart, etc. And I remember it's like, I talked about a guy in a video, a young fella. He basically had this stock and one other stock. I think that's pretty much it. He retired on the 30th of April. I think that's actually the yeah. He pretty much top ticked it to the day. That's when he felt like, he said he was going to retire. He posted his returns in his portfolio for, up until that time for the year, and the year started here. So he posted his results for this like 5-month period and said, I'm retiring, I'm going to turn my greatest hobby into making a living, I quit my job, etc. And during this period of time, obviously everybody thought they were really, really smart. And the more people that got into the stock and just, kept pushing it up, the more people looked on and like, hey, I mean, these guys are making me look silly. I'm barely breaking even here, but these guys are putting everything they own pretty much in one stock, and I, look like a fool when I compare it, because you're watching someone's like probably younger than you, outperforming you by a mile, and he's set to retire. That's not easy to just sit and watch. It's like in the mining sector right now, for example. You're seeing all these other sectors quote work. Well, up until now, pretty much. Now most markets are actually have joined the suckage of the mining sector, but it's not easy to do. To be looking at other sectors, other stocks, etc. See that they are going up in price, while your stock might be going down in price, for example. But as per this chart here, if you're right on the case, it will become a weighing machine in due time. And in the case of mining stocks, we already know that volatility comes from emotions. So we know that it will swing from up and down, up and down. I mean, same ounces in the ground at some point in time will be valued at like $20 per ounce, at some time like $80 per ounce, without anything having changed that much for the company. Sure, I mean, typically a rising gold price, etc. That affects the economics greatly, of course. But like now, for example, or last 6 months, gold has been near all-time highs. And the juniors valuation in the juniors, the valuation of the ounces in the ground for the juniors are not suggesting. They should be close to the highest they've ever been, because the gold sector has been. I mean, it's getting increasingly costly with inflation, but still the major miners are near record cash flow. So you can explain it from a rational perspective, even because gold is actually, relative to, if you put it in sentiment terms, the gold profitability is up here, but prices are down here. And that's again one thing that's like, when people say the market is always right, I see that all the time. The market is always right. The market is always right. It's like, first of all, if you believe that, I mean, at face value, sure, the price is what a price is. And I've been debating with some people like, you can't just sit there and say that the market is stupid. The market is stupid. It's like, sure, I can. Because the market is incredibly stupid. Because if you see the evidence out there in terms of valuations, where the valuations suggest that nobody would be dumb enough to go out and look for gold, because if fair value for success is what the valuations are right now, nobody would go out and look for gold. I mean, do you spend like 10-20 million and like 5 years to prove up something that's on paper worth, I don't know, 500 million right now, and you get 30 million or whatever for it? I mean, that calculation doesn't make any sense. So it's like, I don't get why people keep harping on about the market always being right. I mean, and at the same time, if you believe that, why are you even out there stock picking? Because in that case, it wouldn't matter when you buy. Then there's nobody that could suggest that buying an all-time high is as smart as buying the all-time low for any stock or any market or whatever. Because if the market is always right, that means you're never making a mistake when you're buying. So that's bullshit. So I mean, most people are hypocritical. They proved, basically they disprove their own point, because the same people who say that the market is always right are the same people that are trying to time the market. So why do you need to time something that's always right? In that case, it suggests that yes, sometimes it's wrong, or sometimes it's more wrong than others. And that I agree with. But that's why it doesn't make any sense to say that the market is always right. That's why I, in my opinion, think your base case should be that the market is always wrong, just in varying degrees, because that's going to help you with conviction. Because if you always think the market is always right, you're never going to have conviction. Then you're going to look at the trend. If the market is always right, I mean, take from this peak here, for example, to this bottom here in Evolution Gaming. If the market is always right, one would say that, wow, the company fundamentals have been going downhill for a year. That's simply untrue. This company here I think it's still growing close to like, I don't know, the profit's growing at like 40-50% or something. So if a year passes and this growth rate keeps going, it's like in 2 years it will have more than doubled its business value. But if you look at price and the market is always right, that would suggest that things have gotten a lot worse. That's not the case. It's just that it's the volatility and emotions of people that make it swing around, the weight, the business value. And if we take an arbitrary growth curve, let's say, for the development of the intrinsic value, you see it will go below it and above it, trend above it for a while, go below it, but it always crosses this line pretty much. Even though in the short term it can swing wildly. So, and what I've been talking about, having a long-term perspective, etc., and why I like growth, is because if this company just keeps growing like it has been, and right now I don't see many things, I don't hear many things that would suggest it wouldn't keep growing, the more time passes, the more value it will create. It will be worth more. The value per share will just keep going up. So in that case, even if you bought this top, but the case was intact, the value trend is intact, and price went up here. So let's say it way overshot the intrinsic value for a while. What happens then is that the expected future returns on a given time frame, let's say, it holds up this growth curve. So this is the value in, I don't know, a year or two. Let's say in 2 years this is the value. based on everything we know now, the base case is that value is up here. The only thing that changes then with price in the present moment is that your future returns oscillate. So from here, let's say I think that's like I don't know, let's say a 67% return, let's say, okay, 3 years. That's an 18% compound growth rate, which would be, I mean, that's incredible. That's double the average return of the market. So even if you bought this, you would get, in this scenario, 18% per year expected return in 3 years. But in the meantime, the voting machine took it down like 40, let's say 46% or 40%. The fact that this went down 46% does not change the fact that the business is growing. And does not in this scenario say that it doesn't, if you just hodl this, it would go, let's say it goes something like this. Then you would get your 18%. But if the story is intact and price declines, this future return curve just steepens. It just steepens and steepens and steepens. And right now, based on all we know, we assume in this case, because we look at the signal, which is the value growth trend. Okay, so if the base case is the same, or this is the base case, that's a 177% return. Let's say that's 3 years, even though it will be shorter. That's 40% all of a sudden. So this is not 18% from this point in 3 years would not be bad. 40% would be incredible. But the thing is that you will have to sit through these oscillations in the meantime. But most people, for whatever reason, they always think that, first of all, market is always right, price is always right. If I'm down in the recent past, that means I made a mistake. No, I mean, if we know, let's assume we know that this growth trend will continue, it's going to hit this. What would the mistake be? If you bought here, every day the price goes down with the case intact, that means selling becomes worse and worse. This was the best time to sell. But buying becomes better and better and better and better and better and better, and selling becomes worse and worse and worse. Time has passed, it has grown, and the future returns go up. I mean, this is the whole point. This is why you should love volatility. You should love totally intact, top tier growth stories. When they sell off, without anything having happened that would change the trajectory, because unlike what most people seem to think that a declining share price affects the future assay results. No, of course it doesn't. But for some reason, that's what a poor recent past gets more people inclined to sell, whereas a recent, bad past hikes up the future returns. So the better the recent past, the more it tends to overshoot the weighing machine, the actual business value. And it's like this. Okay, this, let's say, way overshot the intrinsic value. And then it, corrected to the other way instead. Too many greedy people bought into here, and those are the ones that will be selling here. They go from extreme to extreme. They buy when they should sell, and they sell when they should buy. And this is, of course, what we're supposed to take advantage of. The longer a correction goes on and the deeper a correction goes on, the more pain people experience, and the more people will just sell due to the fact that they don't trust themselves. They trust Mr. Market, and after Mr. Market is saying that they're wrong for such a long time, they'll just sell to be done with it. Walk away. They walk away in disgust. While during this time period to this time period, the company has grown at 50%. So your shares have gone up 50% in value, but price has been stagnant. Obviously, this is a much better buy than this. But most people would want to sell here more than here. Why? Because the recent past is an uptrend and they feel smart about it. And that's why I think it's kind of fun. It's like this guy who decided to retire here. I mean, this is when the share price overshot probably the value creation curve the most. So this is the flattest it's ever been, the future return. So he basically retired when the future expected returns in this stock were the lowest they've ever been. And now I've seen people, who have been in the stock, they're like, yeah, back to basics, they start reading up on investing, trying to calm themselves. Like, if there's a time you should retire, that's when you know the best is in front of you, not when the future returns are the lowest. This is, expected to have worse performance than from here. And even if you get this return, obviously, like in this case, for example, you still might have a downtrend like this, 50% down before it goes back up and reaches this point. It's like, yeah, the compounding difference from here, assuming nothing as bad has happened, the compounding went from 18% to 40%. And this is when people sell, when there's like future expected compound annual growth rate of 40%. And that's, again, like I say about sentiment. I mean, if you're confused what to do right now, if you are net selling juniors, let's say, I mean, you're just stupid. That's like I see that all the time recently. People say, yeah, I'm expecting juniors to crash with the market or whatever. So I'm getting out. I'm gonna try to buy in lower. I mean, they of course believe that's true. It's like I said to one person, if you're right, and assuming you even, I mean, if you're selling this low, why on earth am I going to believe that you won't sell this low here? Because you'll have the exact same feelings. No, it's been going down even more. Everybody's even more depressed. You're gonna feel like, yeah, it can go even lower. So you're not gonna buy here. That's bullshit. You kid yourself, because if you were such a good market timer, which is hardest thing to do, I doubt you would be, I don't know, giving such bad advice, let's say. Because if I expect that the future annual returns is 40% from here, but you don't buy that because you think it can go lower and give you 50%. I mean, do you realize how greedy that is? And if you're wrong, let's say it jumps up, and I mean, when are you gonna think that the coast is clear? Is it when this trend line is broken, in case that's up here, and maybe the future returns are like, I don't know, 18%, whatever. No, that's so greedy. That's why it's like, if we're here in sentiment wise in the juniors, and you're holding off because you think it can get cheaper, you have no idea how irrationally greedy you are. That's like, in my opinion, I expect that next sentiment high, my average stock will at least be up 200% from these levels. So if I'm not willing to buy that says that I'm not okay with 200% going forward. Even if it took 4 years, it would still be very well worth it. And since I'm in growth cases, if many of the stores I own, in 4 years, they might have quadrupled their ounces in the ground. So if I think that a trading sardine could go up 200%, what happens if a company proves up 4 times the ounces in the ground? Even if it would be valued at $20 per ounce. If we reach a sentiment peak, and I am sitting in growth stories that have grown for 4 years. So let's say you get a 4-bagger from the valuations on ounces in the ground, and you grown ounces by 4 times. That's a 16-bagger. If you would then, let's say, sell at that next sentiment high. It's like, this is the Great Bear, for example. One of the most well-known success growth stories. You can obviously see that there's a trend here. And this was actually where it got taken over. So maybe actually it's like, who knows, maybe the trend was actually like this. So it was undervalued for a lot of time. I don't believe that's necessarily the case, but let's say, just to make it even or simplify it, let's make it like this. So this is akin to what you saw in the Evolution Gaming graph, perhaps. That, okay, it overshot the value creation trend for a bit, but that doesn't mean this was a bad buy. It just means that it's going to take longer for valuation to catch up. So maybe you'll be maybe value has caught up with it in, like, I don't know, 8 months or whatever, but then it just keeps on growing, etc. So that this obviously isn't a mistake if you look in hindsight. But I bet you that everyone who bought this high and sat through this, or anybody who's seen some people buying all the way down here, they're gonna, ridicule those people. And most will unfortunately believe them the longer this goes on, and the more value creation the company has done, the more it has grown, and the more price diverges away from the value trend. They're gonna believe Mr. Market and every basher and troll out there. And they're gonna be more and more likely to sell as time goes by and price declines, even though the gap from price to actual value is just increasing. And then you have this, catch-up effect. And I mean, take this flash crash here, for example. That level is pretty much back to this level. Do you think that Great Bear perhaps went up in value during this point in time? Yeah, I would think so. Let's say it went up like 3 times in value, but you paid close to the same price. Obviously, this is a much better opportunity to buy, because the price to value gap was huge here, but here it might actually have been above, let's say, the growth trend. So I mean, this volatility, you have to learn to love volatility. You have to learn to take the pain. You have to learn to have extended periods of underperformance so you can get outsized returns. It's like, why do you think when I make it easy for myself, wake up, wait an hour for the market to go, do stuff, and then if I have some dry powder, I'll if I want to make it really simple, I'll just buy whatever completely intact growth story, top tier growth stories out there that's just down the most on any given day. Because Elora, for example, is one of the best examples, I think. Elora has one of the highest ROI when it comes to exploration and creating value. So far, there is not a single blank hole. So every hole they put in shows mineralization. And I'm not saying everything will be recovered. But they also do these 300 meters of like 100, 200 AG equivalent grams per ton. They are creating value faster than most companies because they get show extreme metal content per each drill hole, and every drill hole hits something. So this is Elora has the steepest value creation curve possibly that I know of, I think. And still you have price here, same price as back here. What has happened between here and there? Do you think value might have gone up between these points in time? It has gone up substantially. And since price today doesn't affect future as a result, I mean, it does impact, dilution, etc. But in a case like this, I don't think it really makes that much of a difference because they're creating such an extreme amount of value with their drilling right now. And you could have bought this, and people who sat through it to these points, like, this sucks, yada yada yada. It hasn't gone anywhere, and you see, I don't know what, some other stock that goes up, and people are cheering. But same people sharing like this guy, he's like, yeah, things have gone so well in the recent past that I'll retire now, when the future is much worse than the future would be here. And so, I mean, do I think it's a better buy here than here? You can bet your ass it is. I've been buying. I'm still buying. I'm buying all the time because this is probably not only do I think it's extremely undervalued to where the company is and has proven today, but this gap, since I expect Allura to grow and grow and grow for years. It's like Quinton did a crude calculation. There's like, blue sky potential of over 4 billion ounces AG equivalent. It's trading at 226 million. So if I give Allura my time, they're probably gonna prove up a lot more ounces over the coming months and years. And since I like to look at the discrepancy between price I'm paying now versus the base case future I see, let's say in 2 years they have 2 billion ounces AG equivalent on the books. I'm paying 226 million for that future right now. And that would make it one of the largest deposits in the world, and it might still double after that. We have no idea. It's like, do I think Allura is a no-brainer? I think Allura is one of the biggest no-brainers I have ever seen. And that's why I keep saying that, this market is truly brain dead. Truly brain dead. But this is gonna fatigue most people. Going sideways for such a long time. Going sideways for such a long time. And I'm just buying and buying and buying and buying. Because if I'm right, if I'm even close to right, if I'm even half right on the blue, if I'm even a quarter right on the blue sky potential, and if I even account for the fact that, let's say there's like a 30% chance it would get nationalized even, I still think it would be a no-brainer buy. This is one of the most remarkable, cases. And make no mistake, the junior sector is absolutely brain dead right now, so you should expect stuff like this. But this is one of the most extreme examples of price increasingly diverging from value. And if you account for the extreme trend, this trend growth isn't even close. I mean, this is $4 at 15, that would just be 600 million. So in reality, I think the value creation curve is going something like this, actually. So I think the future, let's say this is my base case for like, I don't know, let's say a year, but let's pretend it's 2 years. It's going like this. Even though price is the same, it's been creating more value, and growth story is intact and even getting better. So this has actually been steepening, especially since they found Porco, for example. So the case, the expected future returns and the expected compound rate just is going absolutely bonkers for every day that passes, and especially when price declines as time passes. Because they're just drilling and drilling and drilling and drilling and drilling and not missing. So this case is, Allura is just, banking more and more value for every passing day. And price recently gone the opposite direction. If I'm even close to being right, if I'm 25% right on my base case, I'm expect to make a lot of money in Allura when this market, wakes up again. It's the same thing here. I don't own Evolution Gaming, but since nothing has happened for the case for the worse, value just keeps increasing. And at one point in time, the voting machine will turn into a weighing machine. And I don't know if that goes like this. Maybe it goes like this. No idea. I just know that this is the stuff you should focus on, and this volatility is the stuff you should take advantage of. And that same goes for any, case. It's like Goliath Resources. I mean, I think they could potentially infer like a 3 million ounce deposit just from this coming drill season. Okay, so fast forward 6 to I don't know, 12 months, let's say. Let's say they have 3 million on million ounces in the books inferred, and they have more targets on top of that, so the actual blue sky is just kept increasing. Do I think that this might look cheap relative to that scenario? Yeah. Do I think 3 million ounces high grade, hopefully, in British Columbia, underground, great metallurgy, etc., with a good land package and more targets to boot, is going to be valued at this price forever? Absolutely not. SK Mining, same thing here, and kind of like Eloro, probably went ahead of itself and just been basically consolidating. But they have identified 8 more targets or whatever. And that's just run TV Jeff. So the blue sky potential and growth potential has just kept increasing. So if we had just TV and Jeff, maybe the growth potential would be like this. But now it's steepening with the more targets. Not that we can guarantee that, but if even, I don't know, 25% hit or whatever. It's like compare it to what you're paying today and what they're probably will be sitting on in 1 to 2 years. I mean, I think it's a no-brainer. And that's also why it's like I already had such a fat position in SK, especially when it went up here. I mean, that was a huge portion of my portfolio. As price declined, while the story got better, that just made the future expected returns go up. So as prices decline for SK Mining without anything bad happening for the case just gets better and better and better and better and better and better. And like recently, there was the private placement overhang. That's artificial selling pressure. Then you have an insider who needs to pay for taxes on his like 22 cents options, who needed to raise cash immediately. So he hammered the price. Nothing to do with this value trajectory at all. Price, however, became very volatile. So the future expected returns just kept increasing because this has not changed. It's only price that has changed. And that goes for a bunch of other stories. And it's like what I like about Colin Kettel, which he posted here. Since gold never seems to want to go up, I decided to invest all my money into Nevada King and Newfound Gold instead. Finding new ounces instead of hoping and praying for gold. That I totally agree with that. That's getting paid to wait. Because Eloro, for example, even if you, and I recently talked about this on K Report, even if you are wrong, that you overpaid, let's say, if the company can find more, let's say nobody knows that, but let's say you paid, I don't know, I'll take a gold example. Let's say you paid $60 per ounce, but you should have paid 40 or 40 or more accurate. If they keep adding ounces, you're going to get bailed out anyway. Because even if you overpaid for an amount of ounces they have today, if the growth story is intact, they're going to find a lot more ounces. So you're going to get bailed out by the fact that the company just keeps growing. And it's this volatility around the intact growth trend that we're supposed to take advantage of. So it's like, don't hate this action. This is how you make obscene amounts of money in a volatile sector. Because even the best cases with the highest growth potential, they get sold off. They can diverge immensely from intrinsic value. And the longer you hold it, the more value will have been created, and there's even more to catch up to. Because let's say here you overpaid in the, let's say you kind of overpaid in the present, even though a stock should be based on all future potential. But let's say, make it easy. Okay, yeah, there's a gap here between price and value. So you had negative expected returns, especially if it stopped growing. And that's for a trading sardine. If this was a trading sardine, maybe the price was fixed here. So here you are in debt to Mr. Market because you overpaid for it. Here, Mr. Market owes you. So it's like one way to look at it, I think, and that goes for Newfound Gold or whatever. It's like, if the case is intact, if the growth trend is intact, if you buy way above the trend line, yeah, it's going to take some time to work through that, and you probably might have a 50% loss in between before it kicks off again. And if you hold it long enough, this buy here will still be profitable. But obviously, the lower price you pay relative to the intact growth trajectory, the better your returns will be. And you see it. I mean, it swings wildly. So that's why it's like with Great Bear, whatever. It's like, yes, you have lows during sector sentiment lows. This was the flash crash. Everything went down, even Great Bear, where nothing changed. And in the case of a stock like Bear Creek Mining, a trading sardine, this low here in time was at the same level as this here. It just goes up and down to the same level, up and down to the same level. Whereas if you just hodl a growth stock like Great Bear, the highs tend to be higher, and the lows tend to be a bit higher. Okay, this flash crashes, and if this flash crash didn't happen, I think we might have a low here, etc. And then at some point in time, you have these very dragged out corrections. And that's when you have the opportunity to have this kind of supercharged future returns. Because if the case is intact, it just means that your future gets brighter and brighter and brighter and brighter the more time passes in a growth stock, and especially as price goes down. It just gets brighter and brighter and brighter. So if you don't understand that, which most people don't, you're selling. The lower price goes, the more time passes. You're selling. When the expected future gets brighter and brighter and brighter and brighter. So like right now, I have like 50 no-brainer buys, and I try to buy, if I have dry powder, I try to buy the ones that simply down the most, because that's where the best expected future returns are. So I have no idea how anyone can even pretend to know what they're doing if they're selling juniors right now. And and there are a bunch of people again that try to convince themselves that they're being smart. They're gonna time the market. Yeah, I'm not buying this low. I think it's gonna go lower, and then I'm gonna buy in. So sure, mate. That's never gonna happen. You're gonna have the exact same thought when it goes down again, that it can go lower, so you won't buy it. And when you're, quote, sure the bottom is in, that's, when it might be up, I don't know, here perhaps. And I will get my returns regardless. So let's say I buy Evolution here, and I just eat the pain. It goes down further. I eat the pain. Hopefully I would be buying, but let's say I'm just holding, because the option is selling, and that's just getting worse and worse and worse and worse. Even if it dropped to here, the case plays out, it's gonna be trading up here one day. So what way it takes to this future doesn't really matter, because the returns are the same. If this starts here, ends up here, it doesn't matter if it went up here, down there, down there, and then ended up here. So I know what my expected returns are. If I think the expected returns are good enough, that's all I can ask for. So if it's 40% down here, but you're saying no to that because you think it could go to 60% per year, that's just way too greedy. You're actually saying that 40% compound annual growth rate is not enough for me, which suggests that your compounded annual growth rate would be above 40%, and that's pure bullshit. So everybody who's going to try to time the market is going to lose. That's just how it is. Dead people are going to be the one beating you if you try to time the market. I don't try to time the market. I already know it's cheap. And I don't care if it gets cheaper. And I had a discussion with someone in the industry lately who said that if you bought here because you thought it was cheap and it went down more, then it wasn't cheap here. That is absolutely bullshit. If it's cheap, it's cheap. And if this plays out, I'll get this return, which will be a very good return. Just because it went down more before it went up there doesn't take away anything from the returns I made on this purchase. But if it went down 50% and you're like, yeah, okay, I thought it was cheap, but now I'm afraid it's going to get cheaper, so I'm selling. You just gave away 40% compounded annual growth rate. Again, if there's anything, you have to hammer this home. Love volatility, love volatility. You have to, because it has such huge effects on your future returns. The only thing you need to be aware of is the value trend of the business, let's say, especially if you're in a growth story. It's like Goliath, better than ever, growth story intact, newfound gold, making new discoveries all the time. It's like, you don't need to be a rocket scientist to understand that they're going to find a lot more ounces. It's like Great Bear. I mean, even at this point in time where they've already drilled a lot, you see here it says open, 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 open. Do you think they could grow even more? Yeah, of course. So was the story over? No. Maybe the, maybe the, growth pace was, petering off because they, it's obviously easier to go from, to double from 2 million ounces to 4 million ounces than 4 to 8 or 8 to 16. So yes, that's true, but at the same time they were past the critical threshold for success, because even if they had 4 million ounces, that would put them in a top tier deposit. So that's going to be valuable, and that's probably going to be the one that's going to be bought out before most others, and that's going to be those stories that are most valuable regardless. So it's like, I don't care. I mean, Goliath, for example, given the average grades we know so far, I mean, that could be a top tier story. So it's just the only thing you need to be mindful of is that, do you think a company, seriously, okay, let's break it down to the most simple way to think about it. Do you think company X is going to be more valuable 1 year from now or 2 years from now? If so, that means the trend is up, and that's going to, base case going to bail you out. So if the growth trajectory is intact, that means that as long as the fundamentals of the company does not change, that means the company will become more and more valuable with every passing day. On average, obviously you can't drill every day, especially if you have a short field season, but I hope you get what I'm saying. So that's the only thing. It's like, buy companies you think will be worth more. I'm not saying necessarily priced more. Buy the companies that you think will be worth more in a year, and worth even more in 2 years, and even more in 3 years. And then you just try to pay as little as possible. But obviously that could be the case, but like if you paid this much for newfound gold, so even if you expect it to be right, and you might be right, I mean, that's not a great expected future return, because if it was trading at, I don't know, 4 billion already, and you think it could go to 6 in 2 years, in your base case, I mean, that's actually not a bad scenario. But anyway, if you think it will go to 6 billion and you paid like 1.4 billion, that's obviously a much better return. So again, just look in the future, and price today, that's the market being an idiot. Just buy the future priced based on today, and the price today is going to be affected by sentiment more than anything else. So now everything is cheap, and since the future tends to be cheaper than the present, because most people don't look into the future more than like a week or 2 weeks, or try to guess what the share price is doing tomorrow, it's like that's the perfect crime. Buy now when everything is cheap, so it's like the odds of you making a mistake are like very low, and buy the compounders. Because if this was a trading sardine, and we were at a sentiment low right now, this is of course Evolution Gaming, but this is your gap. because it's not going to go up in value because it's not doing anything. It has a fixed value. So then you're only trading around this point here. So you would sell up here and you would buy down here. But if it was a growth case, this is actual value to price gap. So that just keeps increasing, and the lower it goes, the lower it goes over a longer period of time, the more they will have created. What do you think Eloro is gonna have drilled up in 1 or 2 years? And compare that to this price here. And if that's not a no-brainer, I'm not saying put all your money into it. That's not at all what I'm saying. But if you don't see that as a no-brainer risk-reward, I have no idea how you think. And there are so many cases like this out there right now that you for sure don't need to go all in on any one growth stock. I don't know how many growth stocks I own now. It's like Cabral, finding more stuff, Scott Resources made discoveries, Nevada King, where Colin is the largest shareholder, I think, in. They're gonna start drilling the Atlanta gold mine again, drilling Iron Point, Goliath, SK, Newfound Gold. I mean, I could go on and on and on about top tier growth stories that have gone down in price, whereas nothing has changed in terms of actually typically gotten better because really good systems or stories with management, etc. They tend to get better with time. So if price declines, that's like, whoo, talk about a fat gift. So I'm extremely bullish on my portfolio simply because price has gone down. Whereas this where is it? Whereas this guy who retired here, up here, he was extremely bullish on his portfolio because it had been performing very well in the recent past, extremely well in the recent past. That made him bullish on his own future, bullish enough that he quit his job. And then he has seen it through this. Do you think he wanted to, right now, do you think he would have wanted to quit his job at this point in time? No. But if he had enough money right now, for example, this is when he should retire, but because this is when the future is a lot brighter than up here. So you get what I'm saying. It's like the worse the past, if a story is intact, the better the future. All else equal. The better the past, and you can see that in every goddamn stock, incredible run. Okay? Had to work through that. And now we're actually undershot by a mile. But it's like, incredible past. Have to work that off. And then we're going to go up in a new one. It's like spike, churn through, let the value creation curve catch up to price, or let price catch up to the value creation curve, and soon we'll be on our way again, and we're going to overshoot this, hopefully, and then we'll probably undershoot it and overshoot it, etc. Yeah, consider me biased. You have to seriously. It's like this is one of the most profitable sectors if you understand what's going on at any given point in time. And it is hard, and the same reason why it's hard is the same reason why it's easy. Right, like right now, people find it hard because everything is down. But if you're a value investor, you find it easy because everything is cheap. And you can have extremely good returns in a volatile sector if you start letting volatility work in your favor. Price is what Mr. Market sets every day. And we let the opportunities come to us. In the future, SK might go like this. If nothing has changed, anything in between can happen, obviously. This is obviously a much better buy than this, if nothing else has changed. Why? Because this is much cheaper. And the future expected returns are much higher than from here. The value expected future return curve is much steeper down here than here. So, and that's also, it's like what Napoleon said. You should always know what to do if the enemy appears in your front, in your rear, on your left flank or right flank. So you should already, if you have a solid strategy, you should already know what to do if it goes down. Most people, they buy here and it's like, yeah, I'm hoping this is the bottom, I'm hoping this is the bottom. And then let's say it breaks here. Then they don't know what to do. And that just means they had no idea what they were doing through all this time. Like this guy. Great returns. But when the reality of how markets function finally sat in, now people are scratching their heads, wondering, going back to basics and trying to figure out. Everybody has a plan until they're punched in the face, like Mike Tyson says. I already know what I'm gonna do in every one of these cases. I only have one strategy: buy something that is undervalued and will grow. I already know that I like SK mining even more the lower it goes if nothing has changed. And I like it less if it goes up and nothing has changed. That's all. It's like you should picture a scenario where any stock you own go down, and then you should remind yourself what the best possible option is at that point in time. Because if your game plan changes, etc., by price going down, then you don't know what price to value is. I mean, I already know what if nothing changed for the worse for newfound gold. I already know I would be piling in if it went down here, and I have already been actually adding to my SK position, which I never thought I would do. I might actually need to sell some in sometime in the future because I need to exercise warrants, etc. But I can't say no when price goes down with nothing bad changing for the case. It's like I like the story even more and more and more and more. So maybe I had, let's say if you had a 20% position in SK here, maybe would have a 30% position down here and a bunch more shares, because obviously if price has gone down and you increase your stake, that means a lot more. That's more than 50% amount of shares. I'm not saying you should do that. I'm just saying that that's how you should think. The more price diverges, the more you love it, because if this is intact, there's no reason for it to go down, and it will go up. It's just that we don't know when. We don't know when this is going to happen. But if the story is intact, one of these days the market is going to turn into a weighing machine. Thanks for listening. Assume I'm biased. I own shares of all companies I mentioned, or assume that at least. I don't even remember all I mentioned. Assume everyone is a sponsor as well. Do your own due diligence. Make up your own opinion. Don't take any risk you're not comfortable with. Don't invest money you can't afford to lose and all of that. Okay, thanks for listening. Bye.